Imagine missing a credit card payment and thinking the bank just lost money on you. Most people believe that when borrowers fail, lenders lose as well, because the entire system appears to depend on repayment. It feels like a simple deal. The bank gives money, the borrower pays it back, and if repayment stops, the bank suffers the loss. But the modern banking system does not actually work in such a simple way. In reality, banks operate inside a financial structure designed to generate revenue in many different situations. That include situations where borrowers struggle, fall behind, or even fail completely. Most people believe banks simply lend money that already exists. They imagine banks collecting deposits from savers and then handing that money to borrowers. This picture feels logical, but the modern credit system works very differently. When a bank approves a loan, it is not just moving existing money from one account to another. In many cases, the act of lending itself creates new money inside the financial system. The loan becomes an asset for the bank and a liability for the borrower at the same time. This means the bank immediately owns a financial asset the moment the loan is created. That asset begins generating income through interest payments over time. The longer the repayment period lasts, the more interest the borrower ultimately pays. Interest is often described as the cost of borrowing money. But from the bank's perspective, interest is the primary engine that powers its entire business model. Time becomes the mechanism that slowly transfers money from the borrower back to the lender. Consider a typical long-term mortgage in the United States. A family may borrow money to purchase a home and agree to repay that loan over 30 years. During that time, the total interest paid can become nearly as large as the original loan itself. This means the bank does not simply recover the money it lent. It earns a large additional amount through interest collected across decades. The longer the loan lasts, the more powerful that income stream becomes. But interest is only the most visible layer of the banking system. Beneath it lies an entire network of fees, penalties, and financial mechanisms that quietly generate revenue at different stages of the lending process. Many loans begin with something called an origination fee. This is a charge paid by the borrower simply for the process of creating the loan. It may appear as a small percentage of the total amount borrowed. To a single borrower, the fee may feel minor. But when a bank issues thousands or millions of loans, those small fees add up to enormous sums of money. The bank earns income before the borrower even makes the first payment. Credit cards provide another powerful example of how banks structure revenue. When people receive their monthly credit card statement, they are usually offered something called a minimum payment. This option allows the borrower to stay current by paying only a small portion of the balance. At first, the minimum payment appears helpful. It gives borrowers flexibility during difficult months and prevents accounts from immediately falling into default. But the financial consequences of minimum payments are rarely obvious. When borrowers pay only the minimum, the remaining balance continues to accumulate interest. The debt stays active for much longer than it would if the full balance were paid quickly. This extended repayment period allows interest to build slowly over time. A purchase that originally cost a few $100s can eventually require far more money to repay once interest accumulates month after month. For the borrower, the minimum payment creates breathing room. For the bank, it creates a longer stream of income. That difference in perspective reveals something important about the structure of modern credit. The system is designed around long-lasting debt relationships. Loans that stretch across years or decades become powerful sources of revenue because interest has more time to accumulate. But the system also includes mechanisms that activate when borrowers begin experiencing financial stress. Late payment fees are one of the most common examples. If a borrower misses a due date, the bank immediately adds a penalty to the account. These penalties can repeat each time a payment deadline passes. Over time, those penalties can grow into significant additional costs for the borrower. Each missed payment becomes another small source of income for the lender. Many credit agreements also contain penalty interest rates. When a borrower becomes delinquent, the interest rate on their account can suddenly increase. A loan that once had a moderate interest rate can become much more expensive. This change accelerates the growth of the remaining debt. Interest begins accumulating faster, making it harder for the borrower to escape the balance. What started as a manageable obligation can begin expanding much more rapidly. To someone struggling financially, this process can feel overwhelming. But inside the financial system, these mechanisms were designed long ago as ways to manage risk and maintain profitability. Another surprising part of the modern banking system appears when we look at what happens to loans after they are created. Most people assume banks hold every loan they issue until the borrower finishes repaying it. That assumption feels natural because the borrower continues sending payments to the same institution every month. But in many cases, The original bank does not keep the loan for its entire life. Instead, loans are frequently sold into financial markets shortly after they are created. This process is known as securitization. Thousands of individual loans are bundled together and transformed into financial products that can be purchased by investors. Mortgage-backed securities are one of the most famous examples. In these structures, large groups of home loans are combined and sold as investment assets. Investors who buy these securities receive portions of the interest payments generated by the underlying loans. This allows pension funds, insurance companies, and investment firms to participate in the credit market. For the original bank, selling loans into financial markets allows it to recover the capital used to create them. That recovered capital can then be used to issue new loans to additional borrowers. This cycle allows banks to expand lending activity far beyond what traditional deposit banking would normally allow. Even after selling the loan, the bank may continue servicing it. Loan servicing means collecting payments, managing accounts, and communicating with borrowers. For performing those tasks, the bank collects servicing fees. These fees create another steady stream of income connected to the loan. This means the bank can continue earning money from the loan even after the financial risk has been transferred to investors. Now imagine what happens if borrowers begin struggling after the loan has already been sold. The financial risk is no longer concentrated entirely in the original bank. Instead, that risk becomes distributed across the investors who purchased the securities backed by those loans. The bank may have already earned origination fees, servicing income, and early interest payments before the borrower experiences serious financial trouble. This layered structure spreads risk across the financial system while allowing banks to generate revenue at multiple stages of the lending process. But the story becomes even more complex when loans become severely distressed. When borrowers stop paying entirely, the loan may eventually enter the secondary debt market. In this market, troubled debts are sold to specialized companies at discounted prices. A loan worth $10,000 might be sold for only a few thousand. The buyer then attempts to recover as much of the remaining balance as possible. If the debt buyer collects more than the purchase price, they earn a profit. Even partial repayment can produce financial gains under the right conditions. This means debt itself becomes a tradable financial asset. What began as a personal loan between a bank and a borrower can move through multiple financial institutions over time. From the borrower's perspective, the debt may feel deeply personal. It is connected to their home, their education, or their daily expenses. But inside financial markets, that same debt becomes part of a large system of financial instruments and contracts. The modern credit economy is built around these flows of obligations. Debt moves through the system generating interest, fees, and investment returns at different stages. This does not mean banks want borrowers to fail. Reliable borrowers who make payments for many years remain extremely valuable. A steady borrower produces predictable income streams that investors and banks can rely on. Stability and repayment remain central goals of the system. However, the architecture of modern finance also ensures that borrower struggles do not immediately destroy profitability. When borrowers succeed, banks earn interest. When borrowers struggle, fees and penalties often appear. When loans are sold, banks collect origination revenue and servicing income. When loans become distressed, they can still move through secondary markets where other financial actors attempt to recover value. In other words, the financial system does not depend on a single outcome. It is designed to continue operating under many different conditions. This design emerged over decades as financial institutions searched for ways to manage risk while expanding credit throughout the economy. Credit eventually became one of the most powerful engines of economic growth. Homes are purchased with mortgages. Education is funded through student loans. Businesses expand through credit lines and commercial loans. Even everyday spending is often powered by credit cards that allow purchases before paychecks arrive. All of these systems accelerate economic activity. They allow people to buy, invest, and build long before they could save the full amount required. But they also create enormous volumes of debt circulating through the economy. Wherever large pools of debt exist, financial institutions build structures designed to manage and profit from them. The result is a complex financial ecosystem where loans become more than simple agreements between two people. They become components of a much larger network involving banks, investors, markets, and financial contracts. Once you begin seeing debt this way, the original assumption many people have starts to change. Banks do not simply win when borrowers succeed and lose when borrowers fail. Instead, the system has evolved to generate financial activity across many possible outcomes. Interest payments generate income. Late fees generate income. Loan servicing generates income. Debt trading generates income. Even distressed loans can produce new opportunities through restructuring or resale. This realization leads to a deeper question about the structure of the modern financial system. If banks can continue generating revenue in so many different scenarios, what incentives actually shape the way credit is created and distributed across the economy? Because once we begin exploring that question, we start uncovering something even more surprising about how modern banking really works. And that deeper structure reveals why debt has become one of the most powerful forces shaping the financial lives of millions of people across the United States and the wider Western world. Many people believe the banking system only works when borrowers succeed. The common assumption is simple: if people repay their loans on time, banks earn interest, and if borrowers fail, banks suffer losses. It feels like a straightforward relationship built entirely on successful repayment. But the modern financial system is built on something much more complex. Banks do not simply earn money from perfect outcomes. The structure of modern lending allows financial institutions to keep generating revenue even when borrowers struggle. To understand why this happens, we have to look at how risk is distributed inside the financial system. When a bank issues a loan, it is not always planning to carry that risk alone for the entire life of the loan. Instead, many loans are designed to move through the financial system. They can be packaged, sold, insured, or transferred to other institutions. This process spreads risk across multiple layers of the financial world. For example, when a bank issues thousands of mortgages, those loans may eventually be grouped together and turned into investment products. These products are sold to investors who want stable income streams from interest payments. Once that happens, the original bank may no longer carry the full risk of borrower default. Instead, that risk becomes distributed across investors who purchase the securities. This means the bank can collect fees for creating the loans, collect payments for servicing the loans, and still move a portion of the long-term risk into financial markets. From the outside, borrowers still send their payments to the same institution each month. But behind the scenes, the financial ownership of that loan may already belong to investors somewhere else. This separation between the borrower and the ultimate investor is one of the defining features of modern finance. It allows the credit system to expand far beyond the limits of traditional banking. Banks can create loans, sell them into financial markets, and then use the recovered capital to create even more loans. This cycle allows credit to grow rapidly across the economy, but it also creates a system where loans are no longer simple agreements between two parties. They become financial assets that move through markets just like stocks or bonds. And once loans become tradable assets, their value depends not only on repayment but also on the structure of the financial contracts built around them. Investors who buy loan-backed securities are not necessarily expecting every borrower to succeed perfectly. Instead, the securities are designed to absorb different levels of risk. Some investors receive safer portions of the income stream, while others accept higher risk in exchange for higher potential returns. This layered structure means that even when some borrowers fail, other parts of the system may still function normally. But there is another dimension to the system that many people never see. Banks do not only earn money from interest payments, they also earn money from the activity surrounding debt itself. Debt creates financial movement. It creates transactions, fees, legal processes, insurance contracts, and secondary markets. Every stage of that movement can generate revenue for someone inside the financial system. Consider what happens when borrowers begin struggling with payments. At first, the account becomes slightly delinquent. The borrower may miss one payment or fall behind by a few weeks. During this period, late fees begin appearing on the account. Interest may also continue accumulating on the unpaid balance. If the situation continues, the account may eventually enter a deeper stage of delinquency. At that point, the bank may begin restructuring the loan. This can involve extending the repayment period, adjusting payment schedules, or modifying interest rates. Loan restructuring can sometimes help borrowers regain stability, but it also creates new financial arrangements that continue generating interest income over longer periods of time. If the borrower still cannot recover financially, the loan may eventually enter the collections process. Collection activity often involves additional fees and legal costs that become attached to the outstanding balance. Specialized collection agencies may also become involved. These agencies focus entirely on recovering unpaid debts. Sometimes the original bank sells the debt to a collection company for a fraction of its face value. That company then attempts to recover as much of the balance as possible. If they succeed in collecting more than they paid for the debt, they generate a profit. This is why unpaid debts can move through the financial system for years. What began as a loan between a borrower and a bank can pass through multiple companies over time. Each company interacts with the debt in a different way, attempting to recover value through negotiation, repayment plans, or legal action. The debt itself becomes a financial asset that continues circulating inside the system from the borrower's perspective. The experience may feel exhausting and personal, but inside financial markets, the debt is simply another item being traded, valued, and managed. The system treats debt not just as an obligation but as a form of economic activity. This reveals something important about modern banking. The system is not built around a single perfect outcome. Instead, it is designed to keep functioning across a wide range of possibilities. Loans that perform well generate interest income. Loans that struggle generate fees and restructuring agreements. Loans that fail can still generate activity through debt sales and collection processes. In each scenario, the financial system continues moving. This design is partly the result of how important credit has become to the modern economy. Over the past century, credit has become one of the most powerful drivers of economic growth. Homes, education, cars, and businesses are often financed with borrowed money. Without credit, many of these purchases would require decades of saving before they became possible. Mortgages allow families to buy homes long before they could accumulate the full purchase price. Student loans allow education to happen years before graduates begin earning full salaries. Credit cards allow immediate spending even when paychecks arrive later. These systems accelerate economic activity. They allow people to consume and invest earlier than their savings alone would allow. But they also create enormous volumes of debt flowing through the financial system. Wherever large amounts of debt exist, financial institutions build structures designed to manage that flow. Interest payments move money from borrowers to lenders. Loan servicing companies manage accounts and collect fees. Investors purchase securities backed by loan payments. Each layer interacts with debt in a different way. The result is a complex financial ecosystem built around the movement of credit. Once you understand this structure, the relationship between banks and borrowers begins to look different. Banks certainly benefit when borrowers succeed. Reliable borrowers produce long-term interest payments that generate steady income. But the system is also designed to remain profitable even when some borrowers struggle. This does not mean banks want borrowers to fail. Widespread defaults can still create major financial instability. History has shown that extreme debt crises can damage entire economies, but at the individual level, the system includes mechanisms that allow financial institutions to manage risk and continue operating. Fees, penalties, restructuring agreements, and secondary debt markets all play roles in this process. These mechanisms ensure that the financial system can absorb a certain level of borrower distress without collapsing. In many ways, this structure reflects the scale of modern credit economies. When trillions of dollars in loans exist across a country, not every borrower will succeed perfectly. Some people will lose jobs. Some businesses will fail. Unexpected events will disrupt financial plans. The system anticipates these outcomes. It spreads risk across investors, institutions, and markets so that no single failure brings everything down. But this structure also creates an uncomfortable realization. Borrowers often believe the financial system depends entirely on their success. They believe if they fail, the bank fails as well. In reality, the system has evolved mechanisms that continue operating even when individual borrowers fall behind. Debt becomes part of a much larger network of financial activity. Payments flow through banks, interest flows to investors, distressed debts move through secondary markets. Each stage creates opportunities for revenue inside the system. Understanding this does not mean borrowing is inherently bad. Credit remains one of the most powerful tools for building homes, starting businesses, and investing in education. But it does reveal how complex the modern financial system has become. What appears to be a simple relationship between borrower and bank is actually part of a much larger economic machine, a machine built not just around success, but around movement. Debt moves through time. Debt moves through markets. Debt moves through institutions. And as long as that movement continues, the financial system keeps generating activity, which means the real story of modern banking is not just about whether borrowers succeed or fail. It is about how the system itself is designed to keep operating no matter which path individual borrowers take.